Hey everybody, it's Mike Weller from the Weller Group at Keller Williams Realty. It is July 10th when I'm putting this together with Momi Pointer here from Arbor Financial. Hi Momi, how are you?
Hi.
So this is one of my favorite new things that we've been doing the past few months, which is Momi's monthly mortgage moment. And we get to chat with Momi a little bit and see what's going on the mortgage side of things. So certainly the last 3 or 4 months have been crazy and chaotic. It seems like every day, just the news is just more bizarre. You were sharing, I hadn't heard the thing with TikTok, how it's a big security threat. And anyway, all of this chaos in the world. I think there's an investment philosophy. When there's chaos and blood in the streets, it's a good time to invest. But in the mortgage side, really, like the crazier the world is, usually means better interest rates. So kind of where we're at.
Yeah, absolutely. Was it in Jurassic World that they were talking about chaos?
Maybe, yeah.
Yeah, great movie. Yeah, Mike's right. We were talking a little bit offline, and when there is chaos, or as we talked about, pessimism, right? And I'm sure the taking TikTok down or not allowing people to be on TikTok is huge pessimism in the social media market, because people love to get famous on TikTok. But the other chaos that you're talking about, I think, is like even the pandemic and the spike in the cases, and still with no vaccine, it is causing investors to run to the bond market, which basically kind of sets the mortgage rates. So mortgage rates are really super low. It's kind of sad. We're in a global economy right now, right? So I don't know if you guys remember the Japanese, when the earthquake happened and the tsunami hit.
I do. Yep.
I don't remember what year that was, but
9 years ago, maybe. I'm not sure exactly when, but yeah.
Right. There were 2 or 3 days where the rates just plummeted, and we were able to lock, and that's on somebody else's catastrophe that affects our market. And so it's global chaos, really, in the scheme of things. But you're absolutely right, Mike.
Yeah. And people, but the smart thing to do for everybody on their individual basis, if it makes sense, is, take advantage of it. I mean, I'm taking advantage of it. We're refinancing 2 properties right now. I know on the real estate side, I've been maybe busier than ever. Certainly the busiest I've been in at least 3 or 4 years right now. I know you were sharing that you've been as busy as you've ever been, pretty much. And And what are the rates? I know you can't quote a rate, but I mean, everybody, for the most part that I know, and it sounds like, everything you're doing, and it varies a little bit depending on the loan type, but you're looking at like in the 2s mostly, right? Low 2s, mid 2s, high 2s, depending on the situation for the most part.
Yeah, for sure. I am the busiest I've ever been. And I think a lot of it has to do with being with the company I'm with, Arbor Financial, and having the ability to broker to 70 different lenders, 50 to 70 different lenders, and set the price for different types of situations. But it does depend on loan type. In the market, there's VA, we all know that, FHA, conventional, jumbo. There's high balance in Orange County, San Diego, LA County. And then, there's USDA. And so depending on those types of loan programs, the rates are ranging anywhere from 2 to 3. The government loans tend to be on the low side of the 2s, FHA, VA, USDA, low side of the 2s. And the conforming tends to be in the mid 2 range. But I have to say, I haven't locked anybody or seen a rate over 3 in a while.
Yeah.
So keep
on an owner-occupied property.
On owner-occupied. Oh, yes, you're right. On owner-occupied, because yes, I am doing a lot of investment properties, and let's be honest, investment properties used to be in the 4s,
right?
5s, 6s.
An investment property interest rate in the 3s is unheard of. That's never happened before, ever.
And that's where
right?
Yeah, and that's where they are right now. They're in the mid 3s, maybe even high 3s, depending on if you have units, 2 or 3 or 4 units. And yeah, you're right, unheard of. I'm shaving I'm shaving off. I can shave off anywhere from $500 to $700. I still have clients coming to me in the fours,
Yep.
not thinking that they're going to save that much money.
Yep. And, it kind of goes back to the whole, buy versus rent, or being a homeowner versus being a renter. When you're a renter, you're not in control of your monthly housing payment. I mean, every year for the most part it goes up, and that's going to happen until until you either buy a house or you leave the earth, or you're no longer a renter. Like it's just going to go up over time. When you're a homeowner, you lock in your rate. And then, especially right now, you can lock in a ridiculously low rate, or even if you're already a homeowner, you have an opportunity to lower your rate, and it's set. And your property taxes are going to go up minimally each year. Hopefully, that stays that way, and they don't do something, different,
crazy on the next election.
Right? Yeah. Yeah, and I know there's a group of people out there that would like to buy, but they're always like a little overcautious, and they're waiting for they're always waiting for the other shoe to drop, or other foot to drop, whatever that expression is. And they're thinking, oh, well, prices might go down. What interest rates coming down, that is effectively your prices have come down, but prices haven't actually come down. So take advantage of this, because in actuality, like the numbers that you sent me over, there's a forecast of, in Orange County, prices are supposed to go up about 7.5% over the next year, and almost 40% over the next 5 years. And that makes sense in a lot of ways when you look at, we just don't have housing inventory. Like there's not a ton of new construction. There's not a ton of places they can build a lot of new construction in Orange County. There's, we're, even though it's suburban, it's pretty dense. There's a lot of people that live here. There's a lot of people that want to live here. I don't see that changing. The housing is going to be in demand here over the long run. So. And
yeah, I agree. For those people that are looking for the other shoe to drop, it dropped. So, hello, it dropped. No, waiting isn't always the most beneficial thing to do for your financial future, because if you can get in a home now with rates so low, your purchasing power, and I think we mentioned this on the last video, Mike, your purchasing power is much higher. You're getting in a lower rate, and you're building wealth, right? You can build wealth once you get into a home. The amortization that you gain, all the equity that you can gain, you can utilize to your advantage. Plus, you also have a tax write-off, and we're not tax specialists, but you do get a tax write-off when you do have a mortgage payment. And a lot of people wait because they think they need to get to 20% down, and you don't need to.
Right. Yeah. I mean, yeah, if you have 10% down, there's absolutely no reason to wait. There's really, well, you tell me, but I mean, there's really, you wouldn't even know that there's mortgage insurance built into those loans. There is, but you wouldn't even know. And even if 3.5% or 5% down, it makes sense to at least evaluate your situation and look at the numbers. And you might be your current monthly mortgage payment or total housing payment, when you throw in the property tax and everything, you might be a little ahead of what your rent is. But when you factor in the tax savings, it really narrows the gap. And then when you talk about what I mentioned before, where you're locking in your housing payment versus when you're a renter, it's going to keep going up and up and up and up. Like, within a few years, it's probably going to be the other way. And certainly in the long run, you're going to be better off. So.
I'm going to use some actual numbers for a client that I have right now that's purchasing new construction, brand new, with all their upgrades. I think it's 423, 425. They're putting, I think, 3% down, because I have them in one of those first time, one of the Home Possible program, 3% down. And this property has HOA and property taxes of, because it's new, so there's Melrose, 1.79. So much, much higher than like in Orange County, right? Which is like 1%.
Well, it's new construction for $400,000. I'm assuming this is out in Riverside or San Bernardino.
Actually, it's in Corona. It's right. It's like the exit right past. Yorba Linda.
Sure.
So it's not far away, right?
Yeah.
It's not really far. It's off the
Well,
91.
that's what I meant. Riverside County. Yeah.
Oh, yes, Riverside County, correct. 425, 5% down or 3% down, and all in their payment. This is principal and interest, which is their mortgage payment, property taxes, homeowners insurance, and HOA. Okay, all in $2,700.
Yeah. I mean,
3% down.
that's not bad. That's really,
Mm-hmm.
yeah.
I mean, 3% down to 425 is what, 15 grand maybe?
Yeah.
Yeah,
Yeah.
$15,000.
So,
So I don't know, and then we can get a grant for closing costs or something.
right.
But so home ownership, I feel most people what they miss is it's more achievable than not.
Yep.
It is.
Yeah, it is. I mean, it's, there's a little bit more here in Southern California. I don't know the best wording here, but there might be a few more challenges to it, just as far as finding the right area that you want to be in. But that's
Right.
That's what we do. We help you with that.
Right.
But yeah, it's I think a lot of people get the mindset that it's not doable, or it's going, or I have to save up 80 grand or 100 grand to be able to
Yeah.
do it, and that's not necessarily the case. So
Yeah, and then let's not forget our vets. You can do zero down.
right, for VA,
Yeah.
which is a great deal. So
And no mortgage insurance. Yeah.
yes, so okay. Well, I think that covers everything. Was there anything we missed or anything else you wanted to share?
No, you went over what the appreciation is going to be. Yeah, I just really, the iteration is rates are low. Really evaluate whether a purchase could be in your near financial future.
Right.
Or a refinance could be in your near financial future. Again, even though you don't think you're going to save money, I think you would be surprised.
Yeah. I mean, like consumer debt is bad, but even if if you have the opportunity to borrow money at 2.5% or 2.75, 2.875, even 3 or 3, like I mean, don't borrow money and then go out and go on vacations and buy boats and jet skis and things like that. I mean, that's not a good financial move. But if you have the opportunity to borrow money at 2.5, 3% and and invest it, and that's what you're doing when you're buying a property, take advantage of that. Absolutely.
That's actually a really good point, Mike. What I'm doing with a lot of my clients is, with a rate so cheap. I mean, what's a credit card rate right now? 14,
Probably,
20?
Yeah, I'm not really sure, but yeah, I would think so.
Something like that. So if you're carrying a balance on your credit card and you have the equity position, I'm recommending, and I have a little comparison that shows if they pay it off, it's like a debt comparison. If they pay it off and get into a lower rate, now that payment is now a tax write-off, right? Because again, your mortgage interest is a tax write-off, your credit cards are not. And would you rather pay, well, like you were mentioning the rate, let's just say 2.875, would you rather pay 2.875 on your money or 14% on your money?
Right.
Yeah. Right. So I and it always makes sense. The amount of money that you're saving from making a credit card payment is huge versus rolling it into your mortgage. And I just don't think people should play the waiting game. They shouldn't wait for the perfect time to refinance or to buy.
And people with equity, and in the past, and I saw it firsthand in 2007, 8, 9, where people doing HELOCs and going on vacation and buying, consumer things.
Yeah.
Not smart. I'm still not a fan of that. But if you have equity in your property and you're able to pull it out at that kind of rate, and go buy another property, go buy a rental property, buy inexpensive rental property out of state, and you're going to get a great return on it. And it's just a smart use of your money and your equity. So, I mean, letting your equity sit there in your house really doesn't, I mean, it makes some people feel good and safe, but it's, if you talk to if you talk to a financial advisor or a lot of people, that's not necessarily the best use of your equity.
No, it's a tool. And the more, if you use it, it benefits you. And you're talking about going out of state and purchasing. I mean, you're licensed in Nevada, right? I see it behind your head.
Yeah.
Like, what could you get an investment property in Nevada for? I'm not real familiar with Nevada.
Yeah, I mean, it really depends on what you're looking for or looking at, but you can anywhere the high 200s into the 300s. I don't know that Nevada would be my recommendation on the place to invest right now. I think there's other out-of-state markets that probably you get a better
Yeah.
return.
Oh,
Like to give people the best information, and I think that's probably good information.
yeah.
But some people like, if they're going out of state, they still want it to be close or close enough. So that kind of leaves you with either Las Vegas or Arizona.
Well, I was thinking more like you could buy near, don't they have a couple universities out there, UNLV? I mean, I'm not real
Yeah,
familiar with
I
the
don't
area.
know that historically university and college area investing has been good, and with the whole pandemic thing, I don't know that that's where I would focus again.
Yeah.
So I think on campus enrollment, I think we might see a drop off in the near to medium term. So
Yeah, for sure. Well, I mean, the whole point of this is if you are renting, call one of us to
yeah,
evaluate your position to buy, right, with rates low. And if you haven't refinanced or are considering, definitely, we're happy to evaluate.
yeah. I mean, for sure, you really, even if you think you're at a great, a lot of people might be at like 3.5% on their home and think it's a great rate. Look into it. You'd be surprised with how much money you will save monthly and over time. So
Yeah, absolutely.
yeah, so
Absolutely. Hey, one other thing I wanted to mention,
sure.
got a new client. They didn't think that they were going to net a lot from the sale of their home.
Okay.
Because everybody thinks, especially in Orange County, that you have to net X amount to buy up,
Mm-hmm.
right? Now, granted, he is a vet,
Okay.
and he does have his VA loan on the current home. So he does have to sell it because I can't utilize VA
Right.
to purchase the next
Yep.
home, as you know.
Yep.
But he's not netting a considerable amount. So let's just say 50, 60.
Okay.
But that ability, I mean, even netting that much or that little, I think that much is giving him the ability to purchase in the $750,000 to $800,000 range. So moving up,
Yeah.
growing family, moving up. So again, going back to your, yes, if you want to refi, that's great. But if you are considering moving up, purchasing, have Mike you should evaluate. And even if you're not going to net a lot, again, we mentioned with the 3 to 5% down, you could do it. Definitely could do it. Your purchasing power could be higher when rates are so low. It's like the perfect storm.
Yeah. So, okay. Well, great chat today, Momi. We'll check in again next month. And again, like Momi said, if anybody, if you're in a property, you want to refi, if you're thinking about buying a property, reach out to me or reach out to Momi. Her information's here on the screen as well. Or even, if you have property and you're thinking of maybe pulling some money out and looking at investing it, whether it be locally or, somewhere like Vegas or Arizona or in another market, I can have a general, I'm not licensed in all 50 states, I'm licensed in 2, but I can have a general educated conversation with you and put you in touch with somebody in a market or a couple of markets that, might make sense, might be appealing to you. So reach out for any and all of those things.
Awesome. Thanks, Mike.
All right. Thanks, Momi. Take care.
All right. Talk to you later.